Well, hello everybody, this is LA. I wanted to do a short video because I think it's more effective to try to explain where the markets are from a neoclassical standpoint and where these retirement portfolios should be and how they should be positioned. As you know, we cut exposure back earlier this year, back in February, I believe it was, for the most part. On the expectation that at best we'd probably go sideways for a while, and at worst we'd see some sort of deterioration. That sideways trend lasted all the way up until August. You can see it here. I've got the NASDAQ composite up, which has been one of the strongest indexes along with the NDX. That sideways trend continued, and then we did something from a neoclassical standpoint that isn't very good from a bullish standpoint. And that is that we broke down, and we broke down on multiple time frames. And when you break on multiple time frames, and what I'm talking about is on the daily chart, right? Also on the weekly chart, you actually broke swing point lows, and you did it across multiple time frames, not just one. When that happens, usually you get some sort of a push to the downside, and that, in effect, right, can lead to much lower prices, but it doesn't always. And as a result of that, you don't want to just assume that lower prices are going to come. What you want to do is you want to give the market a chance to prove to you that that in fact is what's going to happen. And that proof is on the bounce. In other words, when you come back up to test, and you're testing the prior swing point low that you broke, and so you're testing against this low, and here we're looking at a daily time frame still. We can look at it on the weekly as well. When that push occurs, right, and prices do find their way back higher, what happens on that test? Does it get over it so that it can continue back up and come back up to the highs, or does it fail and attempt to regenerate to the downside? That regeneration to the downside is the risk point, and right now it appears that this is trying to regenerate to the downside. Now, to really regenerate, it would have to take out these lows, and so that's a long way down, and we're not quite there yet, but it is, something that this market's trying to do. If we switch to a weekly time frame, and in this case I brought up the S&P 500, you can see here the S&P 500 when it broke, right? So again, going back, we reduced exposure back in this time period back here, right? Expecting that this market was going to go sideways, probably at best. The breakdown on this particular one, of course, was August, just like as we saw there. It broke a swing point low here, another one there, and it actually broke two more down here on the weekly time frame. That push down, right, fast push down, right, then led to a bounce. That bounce is testing into these prior two swing point lows that were broken. And so as we bounce back up, right, the retest, regenerate in this case is testing, and actually it's this one, is testing back into this area. It got about halfway up, and you can see that here about halfway. Bad candle, right? Pressure back to the downside, still inside the big swing, the big lows bar, which tested into the October lows last year. S&P looks as if it's going to try to test back down farther. These are still questionable. In other words, they still aren't showing enough signs that they are going to absolutely fail, but there's more evidence that there's the possibility that they're going to trade all the way to the lows again and potentially all the way to the October lows. Now, where we do have more significant deterioration is over in Europe, and in Europe you can see the way the pattern looked, right? You had the range up here, here's the break, breaks multiple swing point lows, leads to a downdraft, and now prices are actually into that big bar down and look as if they're going to seek the lows and try to break it down farther. That's on the daily chart. If you look at the weekly chart, you're back into already back into the prior swing point high, and so this is a bullish retest regenerate. In other words, you went up, now you come back. The first time it comes back, it's almost, it's a 90% probability it's going to bounce, and that's what it did. It bounced, but now it's coming back to test again. On the second test, there's only about it depends on the circumstances, but in this particular case, there's only about a 60% chance that it's going to hold. And we know that we have a high volume low over here that's a risk point. And so as Europe comes back, and the DAX in particular, the risks are growing that we're going to see even farther moves to the downside. So today I'm going to be removing exposure in Europe, taking a loss on it to reduce our exposure there and our risk of more downside action. At this particular time, I'm going to give the U.S. markets just a little bit more time to show me whether they're going to break down or not. If they are, we're going to reduce exposure again there and continue to raise cash as this market deteriorates. You don't want to do it too fast. There's always going to be some losses at the end if you're doing an investment portfolio, long-term horizon, because you're going to try to ride it and stay with it as long as possible. The key is to take that risk out of the equation as soon as possible on that initial sell, which we did back earlier this year. And so now we're at the point where we can be a little more lenient, if you will, and allow the market to tell us for sure that it really is entering into some sort of a bearish phase versus just some sort of a correction. I believe that's where we're at in Europe, at least. I'm not certain we're there yet in the US. I'm going to give the US just a little bit more time to see how it trades on this retrace back down, and then we'll have to decide on it as well. But in the meantime, we'll reduce our exposure significantly and raise cash again and be more careful. All right, thanks. Take care.